on. So my name is Pete Metz, and I am a mortgage loan originator here in Reading. Been doing mortgages here since 2002. And you see a picture, that's me and my daughter. And a little bit about me. I currently live in Shasta County, and I got the mortgage business, like I said, in 2002. And I started Bond Mortgage in 2019. This is my daughter. She's 11. She's growing up really fast. And I love what I do. We're getting ready for Thanksgiving. We are responsible for mashed potatoes. So if any of you have some good mashed potato recipes, feel free to share those. So I'm going to go ahead and get started. So I have my mortgage is, my office is right here in Reading. So our agenda that we're going to be talking about today is we're going to be talking about what is a first-time home buyer, what are the biggest challenges with purchasing a home right now, what are the financial benefits of home ownership, understanding your budget, the pre-approval process, closing costs, how do those work, and all the amazing programs that are available. So if you stay to the end, I have this first-time homebuyer guide, you can call it, and what it is, about 14, 15 different down payment assistance programs that are available that you guys can look at and see what's available. It goes over the benefits, it goes over how to qualify, it goes over all the information and where to qualify and where to apply for each one of these. And I'm going to email this when we're done, when we're done with the call. So make sure you watch out for this. Super helpful information. So what is a first-time home buyer? By definition, a first-time home buyer is anyone that has not owned a home in the last 3 years. So if you haven't owned a home in the last 3 years, you would technically qualify for a first-time home buyer loan. Let's say you bought a house and you owned a house 6 years ago and you sold it. Well, you would still be able to be classified as a first-time home buyer. You just can't have owned a home in the last 3 years. So what are some of the biggest challenges right now we're facing in this current market? So I'm just going to go over a few of them. So some of the challenges that, are prices are too high, interest rates are too high. Letting someone else in here. Interest rates are too high, mortgage payment versus renting, saving for a down payment, and credit score. So we're going to touch on each one of these challenges as well. By the way, if any of you have questions while we're going over this information, please write down your question in the chat. And if you remember, if you don't, you may not remember what your question was, so write it down in the chat and I'll make sure I'll get to those questions at the end. And you can expect this call to be about 20-25 minutes to go over this information. So the first thing is, prices are too high. This is a challenge that's in the market right now. I want to go over the last 81 years that we've had for home value. So what you're looking at here is what homes have appreciated every single year, all the way back to 1942. So they've been tracking home price appreciation. You can see that we've had 73 years of homes actually appreciating. We've had 7 years where homes actually have declined, and we had 1 year where it was high. You can see here 5 of those years were during the Great Recession, I call it, and those years are 2007 to 2011. So every other year, it was either 1 year where it was a tie or we actually appreciated. You can see every year since 1942. So this is a news article that I pulled that I wanted to share with you guys. I'm going to go ahead and read part of it. So for house sellers and buyers alike, this has been a winter of disconnect, chilled by Himalayan mortgage rates, so rates being higher. To the dismay of sellers, house prices are faltering. to this dismay of buyers that's not making monthly payments any more affordable. So if you've been in the market, if you're looking for a home, you've probably experienced this where you're like, man, these prices are too high, these rates are too high. Home values have to be able to come down sometime soon. So this is another news article in 2017. Well, in 2017, they said U.S. housing bubble in 2017 is no black swan because it's predictable. So they're predicting a housing crash in 2017. Well, what did home prices do in 2017? 2017, home prices actually appreciated 6% in 2017. Same thing for 2018. Why the housing market is slumping despite booming economy in 2018. Well, in 2018, home prices actually appreciated 5% in 2018. Same thing for 2019. You guys are starting to see a common theme. Housing market crisis 2.0 in 2019. They're calling for a crash in the real estate market. Well, in 2019, home prices actually appreciated 4% that year. So this news article that I said in the beginning, this news article was actually written in 1980. You see, every single year we have the same exact challenges or same exact, media saying that we're going to have a real estate crash. But however, every single year, home prices have actually appreciated, except for five of these years, and 2 years where, in 1990, home prices actually declined 1% that year, which I wouldn't really say was a crash. In 1991, it was 0.1% that it declined, and I wouldn't say that was a crash either. So really, we were talking about 5 years from 2007 to 2011 of why we had that real estate crash. I'm going to get into why we are very much not in the same situation that we were in 2007. So this is a more recent picture of what home values have actually done this year. So you might be asking, how do we actually have home prices appreciate when we have interest rates a lot higher? So in this graph, I'm showing you the appreciation like I was showing you before, but what's different is now I put the actual interest rate for that year. So you can see interest rate is in the middle column, the year is on the left-hand column. If you can see it, you can see that in 1942, interest rates were at 3.75% and home prices appreciated 3%. Well, we fast forward all the way to 1980. We get to 1980. Oh, we get to 1974. Rates went up to 9%. We get to 1980. Rates went to 16%. Well, I often ask people, in 1980, interest rates go all the way up to 16%. And a few short years before that, they were at 4%. Sounds familiar. What do you think home prices did? And every single time they say, well, real estate prices had to decline. The prices had to go down. No, home prices actually continued to appreciate. And in 1980, homes appreciated 7%. Now, this data is done by the Case-Shiller report. Case-Shiller has been tracking home price appreciation since 1942. And you can see here for this year, 2023, year to date, we actually see home price appreciation every single month, except for January, where this is a normal, slower time of the year, which makes it a great time to purchase. December and January, because inventory goes up a little bit and people aren't moving as much because most of the time families want to move when school is out of session. And so during the holidays and during Thanksgiving, people don't necessarily want to move. So it creates a decent opportunity to find some good deals. But you can see over the course of this year, we're on pace to have a 6% appreciation according to Case-Shiller this year, another 6%. FHFA is looking at a 7% appreciation. Now, these are 5 different companies that track home price appreciation and predict home price appreciation. So you can see here, the yellow marks are actually all-time high readings for real estate value. So this year, we've seen home values continue to go up. So why is this? Why do home prices continue to go up when interest rates, right now interest rates are in the sevens, 7.5%? Well, the reason why this is because of supply and demand. The supply and demand determines where home prices are. And if we look back in 2007 to 2011, the supply and demand was a very different story than what we have today. So how do you explain supply and demand in real estate? So the first thing is we have to figure out, okay, what is supply and how do we get supply? So to answer that question, we have to answer this question that's on the screen. If someone sells their house, does that create supply? So if you own a home and you want to put your home on the market, is that going to create a supply? Well, maybe, because if someone's selling their house, most of the time they're also going to buy a house. And so it really doesn't create supply. And so when we talk about supply, I'm talking about how many homes are actually on the market. When we have a lot of home market, this actually can create home prices to come down. And so right now, what we have is we have way less homes on the market than what we did back in 2007. So if you're going to sell your house, more than likely that seller is not going to go rent a house. They're going to go buy a house, so that they put a home on the market, creates supply, and then they buy a home, it takes the supply away, so it's a cancellation. That does not create supply. Here's a graph. So back in 2007, this is nationwide. In 2007, we had 4 million homes nationwide on the market at that time. Well, fast forward all the way to 2022, 2023, we have less than 1 million homes on the market. So that's only a fourth of what we had on the market from back in 2007. And our population has grown by a lot since 2007. So that gets me to my next point. How do we track demand? Well, what demand is basically the population. So we have to look at how many people actually need housing. When my daughter moves, she's 11. When she turns 18, 19, 20, she's going to go live on her own. And I'll let her live with me until she's 30, 40, as long as she wants. But unfortunately, she's going to want to move out at some point. And when she does, she's going to create what's called a household. She's going to create another household. So we call this a household formation, is where we get the demand from. And so this household formations we can actually track. So what we have here is we have a graph that's showing you how many household formations, or how many people that are in the population that need housing back in 2006. You can see here, this orange shows how this blue shows how many household formations. So it's right here, 2006, 2007, very low household formations. And then this orange shows how many new homes are on the market. So inventory, if it's not created by someone selling their house, how do we get more homes on the market? Well, we get more homes on the market by builders building new homes. And so what happens is these builders, they haven't been able to keep up, which is why we have way less homes on the market than what we did back in 2007. If we fast forward all the way to 2023, you can see that the household formations are way more than the actual household completions, or new homes that are being built, put on the market. So it's exact opposite of 2007, which creates an amazing opportunity for first-time home buyers. I'm going to get to that here in a minute. Local Shasta County numbers, you can see how much homes are on the market. So in our county, we have about 183,000 people in our county, total population. And for every 1,000 people, there's only 2 homes for sale in our county. And you can see here, for first-time home buyers, there's about 1,400 first-time home buyers that are buying today, that are qualifying and purchasing, that are buying homes. but you can see only 373 homes are being built. So we have this many people buying homes, but we only have this many homes being built. And so you can see how home prices have the demand. Because of the demand, they just have to go up because there's not enough homes to go around. Okay, so now that I talked about supply and demand, I'm going to get into more of understanding your budget and how to qualify and what can you expect for some payments and how does this work. So when calculating your mortgage payment, you want to make sure that you have your principal and interest in that payment, your property taxes, mortgage insurance, and homeowner's insurance. Now, when you go to Zillow or realtor.com, you're looking around, you see a property, let's say it's $350,000, and you look at the payment. Now, that payment may or may not be very accurate. More often than not, that payment's not going to be accurate. And I'm going to get into what the payments are here in a second, but you want to make sure that the mortgage payment has the principal and interest, the property taxes, the mortgage insurance, and homeowner's insurance. You might be asking, what exactly is mortgage insurance? Well, if you wanted to buy a home before the 1930s, there was no such thing as a first-time home buyer. There was no such thing as any of these programs that you could buy and put and do 100% financing. You couldn't do 100% financing. You had to put 20% down. Well, it's the same today. The banks won't lend to you unless you put 20% down. So on $300,000, that's $60,000, and most people don't even have, that $60,000. So what they did is they said, let's create a way for people to be able to buy, put less down, maybe 100% financing like these programs, and we can also cover our risk. That's what the banks were saying. And so what they did is they created an insurance policy. So this insurance covers the bank. It does not cover you. However, it allows you to purchase 100% or put less than 20% down. It's a very good benefit because you don't have to save up for this large amount of down payment, which is great. And so let's say you wanted to purchase, I have two examples here. So I have a $250,000 purchase and I have a $300,000 purchase here. So if you wanted to buy for $300,000 and not put any money down, put zero money down, that payment with taxes, insurance, and that mortgage insurance is going to be about $2,300. And so if you wanted to buy for $250,000, that payment would be about $2,000 per month. Now, you might be asking, Pete, why would I want to buy a house? Tell me why I should buy. You might be paying, let's say, $1,400. Why in the world would you go from $1,400 to pay $2,300? That's a $900 or $1,000 more per month. So I'm going to answer that question and show you why it would be a smart decision to go ahead and make this purchase. So let's say you did purchase for, let's say, $300,000. Well, this $300,000 home. Now, when we look at market appreciation, I'm going to do a very conservative of 4% appreciation for this piece of real estate. You can see here in Shasta County, if we go back 63 years, the average in Shasta County appreciation is 4.9%. Over the last 5 years, home price appreciation is 6%. And so it's very conservative for me to say a 4% appreciation. So let's say you had a 4% appreciation. Well, if you bought for $300,000 in 5 years, you'd spend $142,000. Seems like a lot of money, and it is a lot of money. If you paid rent, remember, rent goes up every single year as well. Your landlord isn't going to call you and say, hey, congratulations, this year we're going to lower your rent. No, every single year that rent is going to continue to go up every single year. And what's great about owning a home is that a mortgage payment is fixed. These are 30-year fixed mortgages. And so this payment will never go up. It's going to stay the same for the entire 30 years. And so you're locking in your housing payment, which is great. In fact, what's even better is that when interest rates do come down, you actually have the opportunity to lower that payment and get a lower payment as well. The rent, it's never going to do that. The rent is going to continue to go up every single year. Well, if you're paying $1,400 in 5 years, you pay $92,000. Yeah, you pay 142, so it definitely is more. It's about 50,000 more over that 5-year period. However, of that 50,000 that you paid more, $19,000 paid down your principal. So you didn't lose $50,000. It was only $30,000 more because you paid $20,000 or $19,000 on your principal. So your loan balance got lower. That's not the full story, because the home that you bought for $300,000, that home in 5 years is now worth $365,000. And that's just in 5 years at a 4% appreciation per year, very conservative. And so after 5 years, your loan balance, because you paid down your principal by 20, your loan balance will only be $274,000. So you're going to have $90,000 in total equity in 5 years, compared to paying rent and not having any equity after the 5 years. You see, for $300,000, this year shows you over the last 63 years, home prices appreciated 5%, and I was using 4%. The last 10 years, 5.16% on average. Over the last 5 years, 6%. And you can see how fast this can grow wealth for you and your family. Let's say you went out 10 years. Well, in 10 years, you're paying an extra $1,000 per month. In 10 years, you're going to have $230,000 in total equity. Your home will have appreciated $185,000, and you would have paid down your loan balance by $44,000, and so you'd have $230,000. Now, here's where the difference comes in. Let's say you did not buy a house, and let's say you continue to rent, and you continue to rent. Instead of taking $1,000 to buy a home, let's say you just took that $1,000 and gave it to a financial planner. Well, what kind of rate of return would you need to get $230,000 after 10 years? Well, if you took that $1,000 and you gave it to a financial planner, you would need a 14% return on that $1,000 every single month. In 10 years, you'd have the same amount of equity that you would have on owning your home, buying a home. 14% return in the marketplace is extremely difficult, not to mention the discipline that it would take you to give $1,000 every single month to a financial planner. You see, owning a home, this is kind of like a forced savings account. And if you can afford to buy a home, it's so smart to buy as soon as you possibly can to get into a home. Now, you might be thinking, Pete, the home prices have appreciated so much and interest rates are so high. We have to have a crash. Home prices have to come down. Well, this has happened in history before. So if we go all the way back to 1943, this has happened multiple times in history. In 1943 to 1947, home prices actually appreciated during those 5 years 118%. So in 6 short years, home prices over doubled in 6 years. Now, someone looking at wanting to buy in 1948, they might be saying, oh, I'm not going to buy right now, even though I can afford it. I'm going to hold off and I'm going to wait to buy for home prices to come down. Well, if they did that, they would have had to wait 43 years, the next 43 years of home price appreciation, until they saw a 1% decline in 1990. You see, home prices continue to go up because of supply and demand. There just not enough homes to go around for the population. We see it again in 1974. From 1974 to 1979, home prices appreciated 93% during those 6 years, and they would have had to wait another 10 years for home prices to go down just by 1%. And so everyone focuses on this 2007 to 2011, and it's not a smart way to do it, because during this time we had 4 million homes on the market during that time, and now we have right about 1 million homes on the market for 2023. Significant difference on how many homes. So if we look at Shasta County, in Shasta County right now we have 620 homes on the market. On average, from 2000 to 2019, Shasta County had about 1,200 to 1,300 homes during this time on the market, over double what we have today. And over double the amount of homes on the market, we still saw appreciation of all of this appreciation here from 2012 to 2019. Now, in 2007, 2008, 2009, how many homes do we have on the market in Shasta County? We had about 2,500 to 2,800 homes on the market here in Shasta County that caused a significant decline in real estate. And so I can tell you that with this many homes on the market, there is not a crash happening. Home prices are continuing to increase in value. Okay, so the next thing I want to talk about here is the pre-approval process. So what does it take to get pre-approved, and how does that happen? So there's 3 things that we need to help you get a mortgage. The first one is credit. Next one is income. The next one is asset. There's 3 things that we're looking at. So on your credit score needs to be at least a 600. Here's the thing. I've helped many families with their credit. I would not be worried, or I would not, get discouraged whatsoever if you have a credit score underneath that 600. I can definitely help you. I would, in fact, love to help you and help you increase that, and show you and teach you how to get that score up and maximize that score. Now, income. What does it take to qualify for income? Now, how much you can qualify for is based on your monthly income, not really your credit. Your credit basically qualifies you to get into the game, to actually play the game, and to actually buy. You need the income to help qualify. So how does this work? They call it a debt to income ratio. The debt to income ratio works like this. If you take your monthly income, let's say you're making $6,000 per month, well, your mortgage payment plus any car loans, student loans, credit cards, or any other monthly expenses, these are monthly costs, not the balance. We don't care about your balances. We don't care about the total amount that you owe. What we care about is your monthly expenses, your monthly payments. And so you take your new mortgage payment plus car loans, credit cards, student loans, any monthly expenses. Now you would of course take out utility costs. That's not going to be on your credit. It's really what's on your credit. So you add all that up, that cannot be more than 50% of your monthly income. So if we go back here, you want to buy for $300,000 on that payment. Where is it at? Let's see, right here. Right here. So if you want to buy for $300,000, that payment's going to be about $2,400 per month. So if you wanted to qualify for $300,000, you would need a combined income for whoever's on the loan of about $6,000 if you have car payments. If you don't have any payments at all and debt, and it's just your mortgage, well, then you could probably be able to buy for, having about $5,000 per month in income to buy for $300,000. Now, I wouldn't worry too much. I'm going to help you with this, and if you have any questions, or I would love to talk with each one of you on your specific situation, and I can go through this specifically for you. And so when it comes to the income, think about 50% of your monthly income your mortgage payment plus car payments plus any other payments can't be more than 50% of what your income is. So that's income. Assets, you want to try to have some savings, and not for a down payment, because we can do 100% financing. And I'm helping about 4 or 5 families this month buy their first home, and they're not putting any money down. Really amazing. I mean, they're getting their deposit back. They are not coming out of pocket for any money, and they're super excited. They're renting. And so we can help you with this. The one thing I do recommend, though, when it comes to assets, what I mean by this is savings in your bank account. You want to try to have some savings. And what I recommend personally is that you have at least, as much reserves as possible of the payment. Let's say that payment is $2,400. You want to try to have at least 2 months, 3 months, 4 months, up to 6 months of reserves of that payment left in the bank account after you close. This will help you. It helps with any kind of emergencies that come up. It's going to help maybe with furniture or any repairs, or just have a comfort that you have that in the bank when you close on your home loan. Okay, so what are the closing costs and how do those work? Closing costs are expensive, and they're more expensive for first-time home buyers because a lot of these programs that you'll see in this guide here, they are more expensive because they do provide and help you with a down payment, but they do have these costs. And these costs, you might be wondering, well, gosh, Pete, who pays for this? Because if we're having our down payment covered, who's going to pay who's going to pay these closing costs? Well, who pays them is a good question. And the answer to that is we get the seller to pay your closing costs for you. And it's about 5 to 6% of the purchase price. Now, I'm a bank, so we fund all of our own loans, and I am responsible to disclose to you all of the closing costs. And so all of these closing costs aren't not just mine. In fact, I just have 2 of these. So processing and underwriting, these are the only 2 fees that come from me, the lender. Everything else is a third party. So you got the lender, you have the title company, the appraiser, the notary, the county recorder. There's many parties that need to get paid for a purchase, for a real estate purchase. And by the way, I do have a podcast that I'm just launched geared specifically for first-time homebuyers. I'm going to share that with you once I have it updated, and you guys can go through the content, really good content on, what these closing costs are and different things like that. Okay, so how does this work? How does the seller pay your closing costs? So I'm going to get my little pen here and write and annotate here. Okay, so let's say you found a home. Now I have the purchase price at $200,000. This is to make easy numbers. So at $200,000, you find a house listed for $200,000. Let's say those closing costs are $7,000, and you want to make sure that the seller pays all those closing costs. So let's say you offer $200,000 and you want the seller to pay this $7,000 of closing costs. That means the seller is going to get $193,000. So you're like, Pete, what if the seller doesn't want to get 193? What if they want 200? Well, then of course, what you could do is you could say, okay, fine, I'll give you 207 for the house, and still ask for that same amount for the closing cost, and then the seller's going to get their $200,000. Now, yes, what happens is you increase the price and you get the seller, and then the seller is going to have the 200,000 that they initially wanted. What you're doing is you're basically financing in those closing costs with your mortgage, because your loan amount is going to be 207 instead of 200. It's not going to change your payment. This payment be more expensive by about $30, $40 per month. And so, but it allows you to save the 7,000 where you don't have to come out of pocket with any money. So that is the closing costs, and who pays for that. Get my tool back again. Here we go. Okay. And then, so the next thing is, what are all these programs? what are these down payment assistance programs? So what I recommend is you don't have to understand and know these like the back of your, hand like I do. This is what I'm here for. Think of me like a doctor, and you're going to come to me with your symptoms or come to me with your specific situation. And then I know all these programs, and I'm going to prescribe, or I'm going to give my recommendation if I was in your spot, what I think you should do and what programs you do. I know all the programs, so I'm going to recommend the program that gives you the lowest payment, the lowest cost, and the best deal for you and your family. Now, these are all 30-year fixed mortgages, so they're all great loan programs. Most of them are programs from the government. And so think of me where I can actually help you and recommend what is best for you and your family. In the chat that you have, I'm going to put my link, and you can book a free, no obligation, of course, appointment with me that's where take maybe 15-20 minutes, and I'll go through your situation, answer your questions, and I can help you with this process. And of course, again, if you have questions on credit, questions on income, no question is a bad question. I truly have a passion to help you guys. I really want to see you and your family get into your first home. I would love to help you guys out. And so I'm going to go over the three main loan programs real quick. So each program that you see on here, there is no other loan program. So every loan that's done here, there is no other loan that's done in the United States that's not on this sheet. So you see here the down payment requirement. There's many options that you're going to have, and that's where I come in and give my recommendation. And so you see conventional has a down payment minimum of 3%. FHA has a minimum down payment of 3.5%. USDA is only 0% down, and VA, if you're a veteran, of course, 0 down. If you're a veteran, by the way, I would love for you to put your comments in the chat, and thank you if you are a veteran for your service. And so each one of these, so the conventional loan has a down payment requirement of 3%. Now that's where these down payment assistance programs come in. They help you with the down payment that's required. So FHA requires 3.5. We give one of these programs to cover that 3.5% on your loan. So what's next? So what I'd like to do is I would love to meet with each and every one of you. Feel free to book a free, 15-minute call with me. You can go click on that link and book the call. Whoops. You can book the call, and I would absolutely love to meet with you. I'm going to email you this down payment assistance guide right here, and along with everything else, I will for free give you what's called a free soft credit pull. That credit pull, it's not going to be an inquiry on your credit, and I'm going to erase this here. There we go. It doesn't affect your credit score at all. It's free. It's a $28 value. I actually pay $28, but I do this to help you guys out and to get you guys on the right path. And so go ahead and I'm going to open it up for any questions that you guys may have and that I can answer for you on this call. So if you have any questions, feel free to put those in the chat. Well, it sounds like I did a great job explaining everything. If you guys don't have any questions, I would love to hear from each and every one of you, and I would love to meet with you guys. feel free to click on that link. I'll also text you that link as well when we're done with the call. You guys can go ahead and book an appointment. Thank you so much for joining me. And if I don't talk to you before, I hope you and your families have a great holiday weekend this weekend. And we will talk to everyone very soon. Thank you so much.